That's my quant.
Your what?
My quantitative.
You show me a pay stub for $72,000 on it, I quit my job right now and I work for you.
Be first, be smarter, or cheat.
Mr. Patel.
Sell it all today.
Mamacitas.
It's beautiful.
Señoritas.
Welcome to the fucking show.
Papacitos. It is another beautiful day to be here with everybody. Mr. Patel, first and foremost, how are you doing?
Good, man. Just been busy doing the thing that we spoke about. Everything hopefully works out for me, and we'll be not here anymore. We'll be somewhere else. Probably in the next 60 days.
That'll be fun. Yeah. I'm sure it'll be fun getting the office all hooked up, and it'll look a lot better than mine. That's for sure. I've been lazy the past.
No,
2
I'm not
years
I'm not getting deported back to India before everyone starts asking in the comment section. Trump is not coming for me.
Dude, I had an interesting conversation at work with someone today. She was like, I'm afraid to go back to India. And I'm like, have you been doing anything stupid that you shouldn't be doing? And she was like, no. And I was like, then you're good. She's like, I've been hearing stories. And I'm like, these stories are these people that are actually contributing member to society? And she was like, well, this, that, and the other. And I'm like, yeah, so you're good. Go back home, visit your family. I'm sure you'll be fine. People are just all freaked out about, I think, God knows what. It's like, yeah, of course, some people that are doing some illegal shit aren't going to get their visas renewed, but
yeah,
everybody else is doing stuff that's perfectly fine.
I mean, I'm a citizen, so I'm allowed to criticize the president. So just letting you know, if ICE is watching, I'm a citizen.
You served our armed forces. So
then again, you can get denaturalized now, which is a big change. I never thought that we would ever see that happen, where someone could be stripped of their citizenship. Though I'll be honest, I sort of agree with it. I know that's controversial for someone who is a naturalized citizen. There are a few people that are here and they take advantage of this country. They have no dream of assimilating into this culture. But I think it's on a case-by-case basis. I mean, I don't expect someone in their 50s and 60s to try to become an American, Americana all of a sudden. There's a level of assimilation that you're just not going to get. But someone who's here, you've been here in your 20s and 30s, at least take the opportunity to learn some of the customs here, learn about the ethics and the morality of this country. Don't bring the ethics and morality of your home countries here and try to impose that will. And I think that's the part that probably pisses people off the most. It's like when you try to bring your culture here and your culture doesn't necessarily align with the views of the majority of this country, right? So when that happens, I feel like the native population tends to be a lot more unforgiving of the way that they treat us. I'll give you an example of something that.
All right, we are starting off Cashflow Chronicles on the absolute wrong foot, everybody. How's everybody doing? Let's get into some stock market talk before we lose half of our audience. So how are things with you? How's the portfolio? How are things looking?
They're looking good. I've been de-risking a lot, actually, thanks to this broad rally that we've been having. I did take some profits on some Meta short calls that I had earlier that were nicely rewarding. So now I just have some naked Meta calls, hoping that Meta has a nice little inflection on their earnings. Maybe Zuckerberg can clear up what their intent is regarding Reality Labs and how they're going to allocate capital. And I think if he can just bring some more confidence back into the company, I think there's a chance that this rallies back to the 700s, in a relatively short period. But once again, what we have to remember in this market is that there's two parts to it. There's the actual value that the business generates, and then the perception that is out there. So if you look at some of these SaaS names, I have it pulled up here.
No,
it's okay. Yeah, let me just share. There you go. Yeah, so if you look at these SaaS names, most of these SaaS names are doing extremely well from a business side, but look at them. Some of them are down almost like 70%, like Figma, which Adobe tried to acquire, I think about 2 years ago. They're down almost 70% since their IPO. Monday.com is down 53%. ServiceNow, which is like a great company, but its growth rate is starting to slow and the market is just not feeling it. And so you're seeing this massive sell-off in ServiceNow. And it's just, it begs the question, are we disconnected from the fundamentals, right? So when you have a company like ServiceNow, you can see that its even projected growth is still pretty high, and their operating income and their EBITDA is really, really nice. It's not declining at all. Then why is it getting sold off so much? And I think this is where the market can sort of like transition sometimes into immediate return versus real fundamentals. And I had messaged people on the Discord today that I said the market is disconnected from fundamentals, and you're seeing these unprofitable companies that are just purely riding on themes just absolutely skyrocket. So, it definitely gives me like a 2021 SPAC vibe, even though I think it's not to that same exact level. Have you been feeling in a similar way?
It's definitely been interesting, I'd say. And I felt this way a couple months ago when we were still doing the show. And I remember iterating very intently that people need to be cognizant of why they're up. Is something actually executing to the way that it actually should and it warrants that? Or are they potentially just in a good sector and they're just being dragged up? And I called out a few names I remember back then, and I remember a lot of people being like, "Oh, Matt, you're being too aggressive." But still, even after the November recovery, right? It wasn't too long after that we saw a lot of companies get cut in half. Rocket Lab being one of them, right? And I remember telling people, I was like, some of these companies get cut in half, and some of them will rebound, and some of them won't. And there's a lot of companies that, even though they hit all-time highs or everything in November, some of which have rebounded and gone back towards all-time highs, and others, unfortunately, are really still struggling. So, it really just depends on what people are looking for. But, just be cautious, because I still think that there's a lot of companies out there that don't warrant the price multiples that they're getting. And you can say even that the companies like Palantir, Rocket Lab, some people might be justified in being saying that those are outlandish as well. But those are companies that are actually executing, right? They actually have some tangible deliverables. There's still a lot of companies out there that have moved just for the sake of moving because they're in specific sectors that still haven't delivered shit. So, just be cautious, right? And Chris even asked me earlier, is like, are you taking any profits on some of these things? And I said, I'm not going to take profits on my stuff, right? I still think a lot of these companies are executing. But for those people, that are in companies that aren't executing and it's still a pipe dream, it's still reliant upon the government. Like a prime example is TMC. I still know a lot of people that are super hyped up on TMC. That's still a regulatory event away, right? Like it still could play off very well. But at the end of the day, it's like they're not actually doing anything as of yet. And same thing with some of these nuclear companies. They might be getting contracts, but are they actually going to be able to deliver on those contracts, right? So I don't know. Just be cautious at the end of the day. Like it's different if you have a company that's able to deliver and has been in business, actually has tangible revenues. But it is scary to see some of these people, working on a hope and a prayer, and hopefully revenues eventually follow for them. But sometimes they won't, and so it really just depends on what kind of company it is.
Yeah, well, I mean, the one I would say good thing is that the idea, if it's sound, but they're running out of capital, and the market's just like, okay, we're definitely going to just buy this up. You're going to see a lot of these companies issue a ton of shares because they're going to create a situation where they maximize the amount of capital they have on the balance sheet, so that while they're unprofitable, they can keep investing in the business and get to that eventual finish line, right? So as an example, if you look at something like Oklo, right? Like Oklo, there's a lot of contracts that they've been signing, especially the latest one with Meta. They don't have a single reactor working right now. So there's no proof of concept. They're literally working on it. And their first reactor is not going to be, I think, like fully active until like 2030. I think that they're going to have probably a soft start in like 2028 and 2029. But the key is everyone is in this zone of, oh my God, like I think this is the next big thing. And trust me, it could be it could be a really big thing. It's the same thing for Rocket Lab right now. You know, Rocket Lab, at least Rocket Lab is sending rockets to space. They have a proven vehicle. Their real alpha is going to, of course, come from their Neutron launches. But I think if they didn't have their Electron launches right now, that proves that they can actually get to space, I don't think that the market would necessarily give it the value that it's got right now. But then again, you know, we've also, and this is something that I got to say, you were 100% right on, and I need to take the L on this one, which is when Rocket Lab was only like, I think $4 or $5 billion, in terms of like their true market potential, it was just so high that was a cheap valuation. And they had already kind of like proven themselves to enough of a degree where they weren't like Fugazi, right? There are other rocket companies out there that, in my opinion, they're complete Fugazi. Like they say they can do this, that, and the other thing, but they're not going to go anywhere. They're literally just burning capital. But Rocket Lab is not burning capital. They're burning jet engines and getting shit to space. So you were totally right on that. Now, I contrasted that against you with saying, I think ASTS was going to be a better value proposition because I thought the business model of ASTS would actually outperform. And it did, you know, like in terms of the market belief in it. So right now, ASTS and Rocket Lab are kind of like head to head a little bit. So I feel like both of us were in a position where we were able to kind of ride that wave together. And I think the entire space economy right now is definitely on like the what is it called? The upward move. The question then becomes, is this primarily because of the SpaceX IPO, where people are saying, look, SpaceX is going to come out, they're going to be valued at X. So these other companies that provide similar features, should they be worth more because that's what the market is? So as an example, you know, Rocket Lab does launch services and satellites, right? Which is amazing. So people are saying, well, if we value SpaceX at, let's say, $800 billion, that means that Rocket Lab should be worth at least some fraction of it, right? And that's why a lot of people are bidding it up. And it's the same thing with ASTS, where SpaceX has their constellation, right? ASTS has their constellation, which is now starting to get deployed. And that is trading now at a certain multiple, right? So, I mean, on the one hand, remember, SpaceX does have like real customers doing the internet part. ASTS is relying on its MNO partners. And from what I know, they haven't really put any services out yet, but they're getting to that point where they're going to eventually start generating that revenue. So I think the market right now is kind of front running everything, you know, and I think eventually we'll kind of discover like, okay, what's actually happening here, and what is the profitability of these business models? Are they going to be able to you know, generate cash flows? Are they going to be able to buy back shares? Are they going to be able to, you know, issue dividends? All that good stuff we won't really know, at least for another, like, for Rocket Lab, I'd say probably what, like, you think 3 to 5 years, or you think
For what
sooner?
particularly?
4? Yeah, I'd say around that time.
For what particularly are you asking?
Like a positive cash flow.
Positive cash flow by the end of 2026, early 2027.
You think so?
Yep.
Really?
Yep.
Okay. For me, I think ASTS is probably 2027, 2028 when they start hitting positive cash flow, because most of their cash is going to go into CapEx because they have to build out that constellation in order to make it work. So in terms of shareholder return, you're not going to see any dividends. You're not going to see any share buybacks, at least in my opinion, for the next 5 years, while they're working on literally getting these satellites in the air. You know, once they get that and then they, you know, start generating that revenue, then it's like, okay, what's the total market potential? We'll all discover that. But I think the market right now is already kind of like declared these guys the winners. And I don't know if necessarily they are going to be winners, though it is more like by the day, it's becoming more and more likely. The good thing is both of us have really low cost bases in our shares. So even if we were getting a 50% drawdown, could you handle a 50% drawdown on Rocket Lab?
Yeah.
I'm pretty sure you could. Yeah. So
I just did.
You know,
I mean,
We just did.
Yeah,
Was it really a 50% drawdown in November?
it was pretty damn close. Yeah,
Jeez, man. All right. Well,
I'll have to double
believe
check,
it.
but I mean, it was pretty damn close.
Yeah. I'll be honest. I think if either of them dip another 50% for whatever reason, I might actually buy more. I think I'm definitely going to buy. I will definitely buy more Rocket Lab. ASTS, I have a pretty good position in right now, so I'll just buy more I'll buy Rocket Lab. I don't have any Rocket Lab. I feel like a fool right now because you really tried hard to get me in it at $4. So all the power to you.
Hey man, I mean, I don't think that you should be too upset. I mean, you can't buy everything. You're obviously looking at a lot of things out in the market, but I think it just goes to show you that you can't be right on everything. Just like I'm not right on everything. But I think a lot of people, they message me a lot, and they're like, Matt, like, why aren't you jumping in on BM&R? Why aren't you doing this? Why aren't you doing that? And I'm like, I don't have to be in everything, right? Like, I have my little spot. And I'm okay if I miss out. I'd rather miss out and not have taken the risk than sometimes put my capital at risk when I'm not fully confident in what I'm buying. And I think it goes back to an old saying that like Warren Buffett had pretty much, is like, if you just only had 10 investments, those are the only 10 investments you had the opportunity to make your entire life, you'll probably end up in a better position than you would normally, because you'd put a lot more confidence into those things that you actually do put money into. But I think that so many people have analysis. I don't want to say analysis paralysis, but they're able to so easily put money into the markets these days. Like, there's not a cost of entry of $15 to $30 to make each trade, that they can just whimsically, because they heard it at the water cooler, be able to put thousands of dollars into it. And next thing you know, people are buying the world's like least eligible stocks in some of my opinions. But big shout out to Doug for the 5 gifted, man. Much appreciated. Always a consistent watcher of the show.
Someone asked a good question, like, do y'all use SB lock, and if so, for what? So I don't use an SB lock. I thought about it a couple of times, but it's just, I don't need the capital like that right now, so it's not worth it for me. But I don't think if you are going to do an SB lock, you should do it on a company like Rocket Lab. I mean, if you got a 50% drawdown, I think there's a certain level of margin maintenance that you need to have in order to, I mean, is that the thing? Have you ever used an SB lock, Matt?
I've never used an official SB lock, but I've used short-term margin for small monthly sort of things. So like I needed to bridge something, but I knew I add thousands of dollars to the market every month. So if I ever need short-term like loans or something like that, I'll borrow it really quick to pay off a credit card really quick and then pay it back within a month or two. Yeah.
Yeah. No, that makes sense. I mean, today when I closed out some meta stuff, I also sold a few things here and there because I am raising some capital on the side. So, it's just I personally am not a fan of trying to take on liability that's contingent on the movement of the stock, because if something goes in the wrong direction, it could be something not even related to the stock. It could just be something like Liberation Day, right? If it kicks you out of the position and makes you sell, then you got a bigger issue. So, sometimes it's a good idea to just, I mean, you could take a little bit of margin, I suppose, like maybe 20% margin, 25% margin should be fine. I wouldn't go like crazy. I'd be like, let me just use full margin on something. And then all of a sudden this thing moves down and you get crushed. So that's an interesting conversation. But are there any industries that you're particularly focused on now, like for 2026, that you think are going to be real winners?
For 26, robotics obviously is a big piece of it, but not necessarily humanoid robotics per se. If I find the right opportunity for humanoid robotics, I would potentially take a stab at it. But I just feel like I haven't seen anything that is like dirt cheap, and a lot of it's private, so you don't get to see a lot of the financials and how much money burn, etc. So another one that I'm looking at really is more industrial or warehouse robotics, and trying to decide whether that's last mile delivery, whether that's warehouse optimization or what have you, looking at that to see if that's the right thing to potentially invest in as well. And I know I'm already kind of doing it with Amazon per se, but I'm looking for somebody that wants to use kind of robotics as a service. And there's a few companies out there that have done rather well. And while humanoids are, I think, good, I think more hyper focused, specialized robotics for warehouse optimization right now is something that is a lot more tangible, and it's a super focused area. While humanoid robotics is good, I think we're a far ways off before, not far ways, but we're probably 5 years off from really that starting to generate meaningful revenue. But I recognize that there's a large TAM associated with that because you have an entire human consumer base that would be interested in that. But I think also it's a prime example, right? Some of these will also be fugazi and just DOA, dead on arrival, because look what happened with iRobot. Like, everyone thought that iRobot was just going to continue, and what ends up happening is like you'll find a company, and this kind of goes back to what you were talking about with SpaceX earlier. You have a company that will be able to kind of make its way into a new industry, and then just sit on their laurels to an extent and not be adding back to innovation and things like that. And I think that is partly the reason why space companies are getting such a bid right now, is because you had the Lockheeds of the world, the Boeings of the world, the Northrops of the world, who had the world by the balls and were the leaders in space, and have completely dropped the ball because they were too focused on bureaucracy, dividends, buybacks, etc., and have let the SpaceXs of the world catch up. And so I think that that's what people are valuing some of these space companies as. They're saying, well, the old hat of Boeing and those are out, and these are what's going to be the next future of the industries. And these ones are the ones that are really trying to make sure that their dollar lasts forever and isn't necessarily tied up in executive compensation and what have you. So I think that's partly the reason why people want to get involved in what the upcoming new Lockheeds are. What is the new Northrop? What is that? And so I think that is what they see, and that's what they hope to eventually buy into, is these companies that will be worth $50 to $100 billion. You're sharing something, so I'm gonna pull it up.
Yeah. So one of the things, so my investment thesis for 26, I watched something from Larry Fink today. He was interviewed by CNBC. So one of the themes that I'm going to do, especially, you know me, I'm a bit of a contrarian. So one of the things that I've been noticing is the yield curve is starting to steepen, right? So you've got these rate cuts coming in from the short term, but the long-term rates are kind of just staying where they are. And so if you look at a lot of banks, their business model is very simple. You borrow short, you lend long, right? And you make the money on the spread. So when the yield curve steepens, you're basically borrowing money from depositors at a low interest rate, and you're issuing for debt at a higher price. And so that's why they call it the yield curve, which is steep, right? So the difference between the two is where they make money. So in that scenario, the banks actually do really well, and regional banks for the most part have recovered since 2023, but there's still some room left to go, and I think that could be one area for some good returns. And there's probably a good amount of margin of safety. So this year for me, I'm looking at doing more margin of safety plays rather than trying to hit things out of the park. I still love the cruise lines. I think the cruise lines, especially if you look at Norwegian, it's starting to hit that inflection point where they're paying down a significant amount of debt. They're generating good cash flows. So I think over time they're going to recover. But yeah, you have to look at every company individually. I definitely think this is more of a stock pickers market rather than it being a just buy the index, especially because if you look at some of the companies that are major participants in the index, like Microsoft, Amazon, Meta, even Nvidia, they have not moved an iota in the last 6 months, right? And I think that's just because the market is starting to catch up. So even though the companies are still generating significant profits, they're doing share buybacks and all that good stuff, the market is just saying you guys are out of favor right now. We want to invest in some other parts of the market. I think eventually money is going to rush back into the Mag 7, but it's going to be a little while. So right now, Nvidia has actually underperformed companies like Micron and what's that called? Applied Materials. So it's a very interesting dynamic because all of them are banking on the AI hardware trade, and the AI hardware trade, technically the leader is Nvidia. So you would think that Nvidia would be the main beneficiary of it, but I think the market is just kind of rotating into these other things, and I think eventually that part is going to kind of slow down, and people are going to say, "Why am I in a heavily cyclical industry like memory, like RAM, right? Like Micron? I don't want to be in Micron. I want to be in Nvidia. Nvidia's got durable revenue, long term. They're not cyclical, and a lot of people are probably going to end up, shifting some of their capital back to Nvidia. And I think Nvidia is sort of proving themselves out that they're not trying to just be a designer of GPUs. They're going to do more than that. And that's something that we'll see in the numbers going forward, right? I think Q1 is going to be a very interesting presentation because I think the guidances are going to be very interesting to see. And I think NVIDIA is going to do well relative to the market. I do think that we are due for like a mid-year pullback. So I know a lot of people have been talking about it. So if I think we can, and we probably will see at least a 10% correction in the market at some point this year. And I think being patient and having that cash on the side is going to be the ultimate like investment strategy, so that this way you can pick up some real good quality names when the entire market dumps and we've got fear in the market for whatever reason. I mean, anything could happen, but let's watch this one thing because this is like the second.
Well, before you start, sounds like you're shook, Mr. Patel. Going for safety?
Yeah, man. I mean, I have a couple of reasons why. You know what I'm doing on the side, so I need to make sure that the underwriting team doesn't like look at me and be like, "Huh, what's this? What's that? What's this?" So I'm trying to make sure I'm very stable right now. And then outside of that, I just feel like the market's really frothy, and there's just a lot of speculation out there, and I tend to want to be on the sidelines when I see this speculation. And then we'll see. Would love to know more about the reason for a 10% correction. I mean,
I just think there's a lot of geopolitical risk, and also so that alone, I think I'm more in the favor that I think there will be a 15 to 20% pullback at some point. I don't think we've seen the last of tariff impacts from Trump. I think Taiwan is still a very big geopolitical risk that we have yet to see come to fruition. There might be something this year. And I think that there's just a lot of ongoing turmoil with Ukraine and Russia still, with everything that's going on with Venezuela. I don't think the shoe has dropped on that entirely, because if you think about it, and maybe maybe I discussed this the other night, but 500,000 to 600,000 barrels a day of Venezuelan oil was going to China to pay back debt. That probably is no longer happening, and that oil is likely going elsewhere other than China. And so, and maybe it is, maybe it's still going there. Maybe it's helping pay off debt that the Venezuelans owe China. But I still think that there's a lot. If you're disrupting half a million barrels of oil a day, 600,000 barrels of oil a day, that's a lot. And especially because China's using 20 million barrels. I mean, it's not nothing, but it's definitely not the majority of it. Maybe China just shrugs it off and says, you know what, we'll find our oil elsewhere. But especially now with the continued crackdown on Russian oil, and obviously the sanctions that come from that, I think it's tough. And I think that there's another potential piece of the pie that has yet to be answered for Venezuela. Sorry, didn't mean to sidetrack here.
No, it's okay. You know what's very interesting? I was actually going to play that, but check this out. China refinery. So China actually built a massive refinery for heavy crude processing, because they thought they were going to get Venezuelan crude like completely, and now they're sort of stuck because the way that these refineries work is that, they're tailored to certain blends that are out there. So you can't just be like, okay, yeah, oil is oil. You need to have certain equipment, certain facilities to process this. And so the Chinese, they spent a good amount of money like thinking that they were going to be able to process this thing. And so not only is this, hey, we gave Venezuela money and we're going to lose on it, but now it's like, oh crap, we're probably going to lose money on building that damn refinery that we can't utilize without heavy oil. So the Chinese are sort of scrambling for alternatives right now for heavy oil. I don't know if you saw that right here. Chinese
Oil
alternatives.
It always reminds me of the Dave Chappelle skit. It always cracks me the fuck up.
You cooking? So I think I wonder how the Chinese are going to respond to this. At some point, I think the Chinese are, I don't know what to say.
The thing that's different about this, it's not just a supply chain thing. This is how they were repaying debt. So it wasn't like it was like, hey, Venezuela, like we'll buy your oil from you, no problem. It was, we're buying this from you because you owe us money, not because we're doing good trade back and forth. It's Venezuela, you have no money. We're taking your oil because you need to pay us back. So,
I mean, the Chinese, that's one of the things about their diplomatic style. What they do is they go into these poor countries and they say, we will give you this money, we will build this infrastructure for you, and we'll even give you the loans to build this infrastructure. And then what ends up happening is these countries get over levered, and then the Chinese are like, hey, I need my money back, and these countries say, oh well, I don't have the money to pay you back. And at that point the Chinese just come and they say, okay, well, you know what, in lieu of paying us back, you're going to pay us in kind, right? And so paying in kind is like, we'll take over that specific industry. So they did this in Sri Lanka, where they built an entire port in Sri Lanka. The Sri Lankans couldn't pay them back, so they just basically took over the port, and they did that. They've been doing this in Africa as well. So I think some of these African countries are sort of fed up with it. I don't know how long that's going to last, but they were doing a very similar thing with Venezuela. So basically they were getting Venezuelan, oil, and at the same time they were providing these loans. And yeah, I mean, I don't know what course the Chinese honestly have in order to remedy this thing, other than just play nice with the Trump administration. I mean, I don't know. It's just, I feel like a lot of this stuff is setting up for a kinetic problem that we might eventually have. But as of right now, the Chinese are not necessarily reacting, but that could be a big geopolitical problem if the Chinese somehow got into a shooting situation with like a US Navy carrier, then like that's like World War III status stuff. And I don't know what part of the market is going to be able to survive a complete disconnect between China, which is still the world's largest manufacturing country in the world, and the United States, which is the largest consumer in the world. So I think the one good thing is that the Trump administration has been trying to diversify our supply chains, but this is not going to be like a 1 year, 2 year thing. I mean, this is like multi-decades worth of reshoring that's going to happen. The only thing that I'll say, because I don't want to get too political, is I do feel like the Trump administration needs to ease up a little bit on the Europeans and some of the other countries where he's sort of like alienating them. And they've literally been one of our staunchest allies for like the longest time. And this whole like thing with Greenland, I just don't understand it, because it's not like the EU is saying to the US, like, no, Greenland is ours. You can't do military bases. You can't do patrols, like blah, blah, blah. Like, no, they're basically saying, look, you can do whatever you want in Greenland. Just don't come at us and try to like take the territory and put it under your own name. And the president is just like, no, I don't want that. I want that territory. Like, I want the name Donald Trump to be etched on that territory. And I think that's more ego than actual real use cases, like having Greenland, whether it be in actual ownership versus having it as part of your, strategic aligned territory with NATO. I think it's the same exact thing in terms of like usability. But I don't know, it's just something about the president wanting the the land for whatever reason. It's just it boggles the mind, but whatever. I'm not going to go too far into it.
I will say I don't think that the European Union is. I don't think that today in today's environment they want the United States to succeed, and I'll leave it there. I won't get into a deeper political discussion, but I think based off of what I've seen, the attacks of American politics, etc., that I've seen on X and many other things, I think that there's a larger play that, to me, I think we're setting up more for World War III than I truly believe. There's a lot of proxy wars going on. The EU is pointing their fingers at the US a lot. Meanwhile, we're trying to help end a war in their entire continent. But I think it's just very interesting, and I think a lot of this is, with Ukraine and trying to help with that, plus the Venezuela, plus a lot of other things that have gone on in the Middle East. There's just a lot of proxy wars going on. And when proxy wars happen, generally it ends up in deglobalization, which we've already started to see. But I think we're going to continue to see that. And at some point, there's going to be a breaking point that will end up in and I anticipate World War III.
I will say this: as much as people think that the Europeans hate us, and probably there are elements that do, I don't think X is a real litmus test for the relations between the US and Europe. And I think there are a lot of bots on X. I think over time, over the last probably year, I have noticed so many influence campaigns directed towards breaking long-standing traditions between the United States, Europe, even people in the US, causing chaos and discourse and sowing that in. And I think X is becoming, to be frank, honestly, a very toxic place where you don't know what's real anymore. There's AI generated content, but then there's also like a bunch of these accounts. And then that it was very revealing when you saw some of these accounts that were like MAGA Patriot First. And then you see it and it's all based in Turkey. You're sowing discourse from Turkey. Like, who are you? Who are these people? So I think when I see like some of these Europe First accounts where they're always insulting the US, and I look at like where they're from, and I think a lot of them are probably Russian, Chinese, all sorts of bots that are just there to weaken us. And there are some politicians in the EU that have come out and said some critical things about the US. But then again, it's not like we haven't said some critical shit about them too. So I think this is one of those times where everyone kind of just needs to take a step back. Remember that we're stronger together. The Chinese definitely cannot be trusted, right? And the Russians are literally at your doorstep. So we need each other. Let's kind of like take a step back. Like, yes, the Trump administration is absolutely right in asking you guys to spend more money on your own defense. Like, I have no qualms about that. But to go to some of these other countries, when you go there and you try to dictate politics to them, just like anyone who tries to dictate politics to us, I don't think the Europeans should be allowed to dictate politics to us. We do what we want, but at the same time, we have to respect their autonomy and sovereignty as well. So it's kind of like a weird dynamic. I don't think I've ever seen so much of this happen in the open. You know what I mean? Like, a lot of this stuff probably happened in the last like 50 years, but it happened behind closed doors. Politicians weren't going on social media saying that, like, you guys are idiots or you guys are dumb and, all this other stuff. So I hope that we eventually get to the point where we kind of transition back to a little bit more, like, there's this Southern word. I love, genteel, I hope we get back to a more genteel relationship. And I think it'll eventually happen, because I don't think there's any choice. The 51st state degrees. Yeah. I mean, even the Canadians, I feel it sucks to see Carney go to China today and say that, we're here to make relationships with the New World Order. Like, it hurt me to see that. And the reason why it hurt me to see that is because Canada has been one of our strongest and staunchest allies. After 9/11, the Canadians were right there with us in Afghanistan. All right. Like, every major war the U.S. has fought in, the Canadians have bled and died right by us. So when I see the president sort of, insult the Canadians and stuff. To some degree, I think at first it was just like funny. I thought I laughed it off like, it's funny, 51st state. But then like over time, he's become a lot more serious. And that's when I think the Canadians are like, bro, what the hell? So yeah, I think we've spoken enough about geopolitics. I think we're about to lose some viewers in a bit. But yeah, I mean, for Black Swan events, that's probably one of those Black Swan events where we sort of see a kinetic issue that might be very short-term in impact, but could have an outsized impact in markets. The one big downside that could come up is foreign holders of US treasuries could kind of back off, and that would keep long rates elevated for a longer period of time. And if that happens, then there's a lot of companies that right now that have that are sitting on debt that they're hoping to refinance in the next few years at a more moderate inflation. And if they have to refinance at the current rates that are out there, that means that the bond holders are going to be the ones that are going to do well, and it's the equity holders that are going to be left holding the bag. So one of the things that I'm looking at is I'm actually looking at some funds that specifically target corporate, sovereign debt, and even MBS, because I think that we're likely to see at least another like 5 to 6 years worth of outperformance by the fixed income sector relative to the equity side, but not the entire index. There's definitely going to be a lot more winners on the equity side, but I do think that if you are purely in the S&P 500, you may or may not do that well. I think you'll do better by picking individual stocks, but at the same time having a portfolio that's diversified with some fixed income holdings that you could theoretically liquidate in the event of some major crisis, and then use that to deploy capital into really undervalued equities. Does that make sense? That's kind of.
Yes and no. I do see the piece where you're talking about with the S&P 500. I think there's a lot of companies that are extremely profitable and have been hyper focused on shareholder returns that now in the world of AI need to really rethink their business model, which they might still be great in terms of being able to generate a profit, but their margins are going to continue to get squeezed, and eventually they're going to fall out of favor unless they continue to innovate. And so utilizing and leveraging companies like Oracle and Palantir and the ServiceNows, I think will really help them figure out, okay, what way do we want to take our business? Where is there a lot of efficiencies to be gained, et cetera? I think the companies that don't utilize that AI into their business will eventually fall out of the S&P because they'll either just be zombie companies that don't grow because they're more so focused on dividends and shareholder returns. And I'm all for dividends, right? I think dividends help companies, before I continue down that path, I think dividends help companies prioritize cash flow and understand, how well they're doing, and they have their eye on the ball. But it gets to a point where I think they lose a lot of their founder instinct, kind of like what happened under the Ballmer days of Microsoft, and you kind of fizzle out to an extent. And it takes somebody that has that founder instinct that wants to continue to push forward and innovate that reinvigorates the company. And now you're starting to see what happened with Microsoft. It went from a $500 billion company just literally just over 10 years ago to now on the warpath to being a $4 trillion company. So at 8x pretty much in that time period. I don't think that people fully comprehend that. And so because of that, I think if you don't see more companies that take a hold of their future, you'll end up looking a lot like the Ballmer days if they don't already. And there's a lot of companies that I like, the Lockheeds of the world, et cetera, that have been on that path. And some of them have done well, but unless they truly move into the 21st century, they will be left behind, and eventually it'll be tough. So look for those sorts of companies, right? There's a reason why Caterpillar is going off like haywire. There's a reason why John Deere is going off like haywire. They're embracing AI. They're embracing robotics. They pay a dividend. Yes, they do buybacks, but at the same time, they're investing in themselves versus a lot of companies right now aren't. And so look for the companies that aren't reinvesting in themselves, because those are the ones I would steer away from. So I hear a part of what you're saying there, Chris. I agree with you. And that's always been a part of the S&P. Like, think about it, like cigarette companies, for example. It's like you can only squeeze margins so much. But the benefit that some of these cigarette companies had was they had so many auxiliary businesses, right? Like look at Kraft, look at Mondelez. All those used to be part of Philip Morris back in the day. And so it's like it's not really until they spun off all those other businesses that the companies themselves started to really struggle. So I don't know, just be cautious. I'm the dividend guy for like first I was a dividend guy as well. I get it, but I saw that some of there's a blessing and a curse of being some of these dividend companies. Is it a 2% yield, 3% yield? Then you might be okay. You know, the companies that are yielding less than 1%, generally, it's either because the dividend is new or the company's innovating and growing so fast that the yield stays low. And so they have to increase it so fast that it just can't keep up most of the time. And that's where I'm talking like Microsoft and Meta, et cetera, where the yields are super low. So just be cautious. I agree wholly. Like there's going to be some companies that have just Oracle being one. Like it could go by the wayside. Like it's really taking on a lot of debt. And I think that might be a bookend. And I've talked about this with Mr. Fiorillo, is like that might be a bookend, but the market's looking out and saying, holy crap, if companies aren't diligent about how much CapEx they're spending in this new AI data race, then they could end up like Oracle. And Oracle is in a way different spot than, say, the Metas of the world, the Googles of the world, Microsofts of the world in terms of how much debt to capital they have. Debt to EBITDA that they have. But it is a bookend and a starch reminder that like companies, if they're not keeping track of how much they're spending, could end up that way and end up in a very different place than what the current technology companies and Mag 7 looks like.
Sorry about that. I just had like a thing I just got. Sorry about that. Give me 1 second.
So let's play something real quick. And I think Larry Fink actually outlined this. So let me just share my screen and we could just watch that play. And this is what this is the reason why it's pretty long. Let me just make sure I tailor it to what we want it to be. By the way, BlackRock is absolutely killing it, man. You know, they're managing how many trillions of dollars now? But one thing Larry Fink said is actually really nice. He's like, I'm a big believer in the U.S. The U.S. is not going anywhere. Hold on 1 second. There we go. I think this was it right here. Okay.
If not far beyond plan.
Is this year going to be the year of the steeper curve?
I think so. I mean, I think there's good justification of lowering rates if you believe the power of AI. If you see the deflationary impact of China with $1 trillion trade surplus, these are all very deflationary trends, and the AI is deflationary, and so it may not show up as much in 2026, but out 27 you could see real impact on that, and so I do believe that's going to lead to a steeper yield curve, but. And that is why we think income is going to be a big theme over the next few years.
Let's talk about something that you've come on many times and lamented, that there really wasn't a new generation of savers. You were concerned. I see the possibility here of a new generation. And by the way, the Trump accounts make it best.
Fantastic. Jim, over the last 10 years, we did more to democratize investing. We lowered our fees by over $600 million. So here we are, the scale operator with rising margins and lowering fees. And so what we have done is purposeful, but it is also meaningful. I mean, we believe there's a greater need for Americans and everybody to be investing with the growth of America. And I've talked about it in the past. We're telling people in India, you want to invest with the growth of India. And as the capital markets grow, and one of the big things our year and our quarter really suggest, the growth of the global capital markets is accelerating. The role of the capital markets in each society is, more and more countries are focusing on Pillar 2, Pillar 3 retirement. So it's all intersected with retirement. So as the growth of the capital markets, BlackRock is growing alongside the world's growth and the world's capital markets. And as we democratize investing, as we get more and more people saying, keeping your money in a bank account is safe, but if it's over a 20 or 30-year horizon, it's wrong. You want to be investing with your country. And we don't talk about that. And if you think about the investors, in January 1st, 2000, and the next year we had a 40% drawdown in the stock market. But if you just invested January 1st, 2000, over the last 25 years, you had an 8% compounded return. Okay, and this is why I don't get caught up in the noise and the ups and downs in markets, because over time, if you believe that your country can grow and differentiate us. And I do believe in American exceptionalism. And I do believe that America is going to grow above trend over the next few years. And so we should have more Americans investing with the growth of America.
Right. So you're a believer in capitalism. We know that.
Absolutely.
Are you concerned?
Okay. So stop it there. So I think that was a really good video. It just kind of highlights that. Well, there's three takeaways that I got from it. Number one, of course, was that, there are areas of the fixed income market right now that are going to have equity-like returns with a much lower risk profile. So I think that part, he didn't specify too much, but I think that that's one area we should be looking at, especially with equity risk premiums where they are. So if you buy a company at a 35 PE, or if you buy the index at a 30 PE, you're basically, saying that, hey, I'm going to get my money back in 30 years. That's how the PE ratios work. So when you have like markets that are just so high in terms of like valuation, that means that, you really need to have either hyper growth to make money, or you're going to get at least some level of a drawdown. So number one, from a risk perspective, there are fixed income right now vehicles that you can get like 10 to even 15% return at a pretty, I wouldn't say it's not like super 100% safe, but at a very safe way. So I think that's one of the things that I'm going to focus on. But the other two things that I heard was really interesting, which was getting more people around the world into the capital markets. I think that was a direct mention that I think the rest of the world is going to become more inclined to investing in the stock market at the similar rate that the US does. Like, so if you look at the US, if you look at us, we have some of the best capital markets in the world. We have all these companies. They have great liquidity. So if you want to come out with a company and you're public, you can raise capital. And as you grow as a company, right, the people of that country benefit. Well, there's a lot of companies out there on the planet right now that they're starved for capital. And there are people within that society that want to say, you know what, I want to invest in these businesses. I want to invest in the future of this country, but also the companies that are leading the way. And I think that opening those consumers up to investing is like the next big thing. So I do think that there's going to be a big move, and companies like Robinhood, companies like Webull, companies that get people, especially the average retail investor, into the markets. I think that's going to be like a pretty big growth curve, at least for the next, I don't even know, like maybe next 50 years, to be honest. Like people outside that, like we are extremely blessed that we have access to the capital markets in such an easy way. If you go to other countries, it's not like that, So I think the barriers to investing are sort of like coming down, and BlackRock wants to take advantage of that, and I think they, and I think they will. There's going to be products that BlackRock releases that are going to be like industry specifics to those countries, like an index. Like BlackRock has one specific one for like India, where if you want to get exposure to India, you just buy the BlackRock iShares index that tracks India. If you want exposure to China, you just buy that index that tracks that. Now, the thing is, people in India are going to say, well, I want to buy the S&P 500 the version of it in India, BlackRock will be there to kind of sell that product. But along with that, you're going to see people say, you know what, why am I keeping my money in the bank and getting a single digit return? Why don't I take that money and put it into the stock market and get an even better return? So, yeah.
Yeah, I think 10 years ago when I guess 10 to 15 years ago when I really started getting into the markets, like the India ETFs and the China ETFs that iShares was starting to develop were very new. And now you're starting to look and they have a lot of them. And I think like you stated, it's more about democratization of it. And a key example of this is initially, I think Larry Fink and many others as well were very hypercritical of Bitcoin. And now it's their most profitable ETF. They generate over $240 million in revenue, and it's barely just over 2 years old. And so when you think about it in that respect, there's a lot of money for them to help generate additional streams and access to markets that currently are more difficult to potentially look at and get a hold of. So if they're able to come out with an Egypt ETF or like an India ETF or a UAE ETF, Saudi Arabia ETF, people will have that ability to then invest in those particular companies that otherwise might not have the ability to. So I think it's very interesting to see how that's developing.
Yeah, I think that's another thing. And the last part that I liked was that the US's growth is going to be above trend, right? Which is always good to hear, especially from someone who's like the largest asset manager on the planet. When he says, "Hey, listen," he sees that the US exceptionalism trade is on, like there's not, sounds good to me. The last thing you want to hear is the US has gone into socialism and basically ready to tax every nickel, dollar, and dime that anyone has, and basically is there to kill markets. Like, no one wants that. Like, that destroys economies. And I think that's one of the sad realities of certain European countries, right? Where they've gotten so fixated on taxing the rich and all that other stuff that they've created draconian investing rules that are basically preventing people from going into the capital markets and building generational wealth, to be honest with you. But then there are some European countries that are actually the opposite of that. I think what's his name, Couch Investor, he's in Sweden, and he was telling me like they have some of like the best policies for investors. I think it was like zero capital gains, but you do have to pay, I think, a certain percentage every year. It's a very small percent. I think it's like 1 or 2%. So like, let's say you have $1 million, you just pay a very small amount. As opposed to like for us, like we pay capital gains. Like capital gains sucks, ordinary income capital gains suck. Like short-term cap gains suck. Long-term cap gains, especially depending on your income level, are awesome. Couch is in Belgium. Sorry, not Sweden, Belgium. Yeah. So.
But I think Larry Fink said something else, which you hinted on as well, is like being able to benefit from income. Now, you're not just looking at potential yields, you're also looking at the benefit from the par values also increasing in value from a lot of these income products, because we're now in a decreasing rate environment. And so if you're able to buy something at 7-8% yields, and next year the max yield that you're going to be able to get from let's just say investable grade security or an investable grade bond is going to be 5 or 6%, then the par value of that 7-8% yielding bond is now going to go up. And we haven't seen that, probably since the ability to do that since 2010 to 2013 when they cut interest rates to zero during QE. Because even when we got back to 2018 timeframe, it was such a short amount of time for us to actually grow in terms of interest rates. And then eventually, because of COVID and the repo markets, it got cut. It started in 2019 because of the repo markets, and then it got cut again because of the pandemic. And so we haven't had an opportunity to raise interest rates as far as we have. And now that we're starting to cool off a little bit, it actually allows people to potentially take advantage of that. And so I'm curious to see, and everybody that's in here as well, you have to recognize where you are in your maturity of your portfolio, right? And what you need in the security aspect of things. Like if you're 70 years old maybe you have plenty of money, right? Maybe a 1 to 2% yield on your portfolio, you're able to take and make, use for income or whatever, and you don't necessarily need to worry about it. But I think there's so many different things that people need to take into consideration that maybe a 4 to 5% yield is really what you should be more focused on than trying to grow your portfolio by 20% next year, which I think everyone would hope and love for. But I think there's so many different avenues depending on where you are in your portfolio that I think right now it's a pretty great environment, something we haven't had in quite some time, to be able to throw money in a 10 to 20 year bond and actually get a pretty decent yield. That's pretty badass, and not only that, but if you're able to get it at a decent rate, and then we continue to have cuts like it's being forecasted throughout the entirety of 26 and also 27, which I'm still in between whether or not it's actually going to happen or if we actually end up having a raise towards the end of 27, because we're getting so hot again, in my opinion, that the markets are so hot that that I don't know. I think that you could benefit from having those and being able to sell them for higher par value on the market if you honestly wanted to potentially get out of them. So but I mean, somebody's saying bonds. I mean, you have to think, like, I'm not advocating it for me. I'm not 30, like I'm 34. I'm not going to be going into bonds personally, but I deal with a lot of retirees, people that are either at retirement age or going into retirement. And a lot of them are definitely afraid of putting their money into the stock market, especially at all-time highs here. And so it might not pertain to you, my friend. I get that, considering your name is NASDAQ Poppy. But, there are people out there, somebody earlier in the chat that said they're 60 years old. I'm sure they're loving this advice and hearing I can get a 5-6% yield without risking my principal. Like, that might be something that is extremely enticing to them.
Like my father-in-law's retired. He's got a good chunk of change on the side. He was putting money in CDs. And that's the thing with him. Like, he is at the point in his life where he needs capital preservation during his, like moonlight years. He doesn't need to try to worry about the market correcting 50%. You know what I mean? And that's the thing for someone of that age to see your entire life's work kind of get diminished so quickly. It's it impacts your health too. So there's a part of understanding that as you get older, you definitely need to err on the side of safety and security more than total gains. But if you're young, don't be averse to risk either. So if you're like in your 20s, you're in your first job and you've got a little bit of money on the side, go for it. Speculate on that, that small cap or mid cap company that has the potential to 20x, like Rocket Lab, right? But if you're like 60, 70 years old and you're like, yeah, let me buy this drone company, be careful. Don't, you could do it. Just don't put such a significant amount in there that if you lost it, your entire life is going to end up going down the gutter, right? It's just good sense and good. So one of the good things is that interest rates right now, I mean, and especially among bonds, they are giving good enough yield so that a lot of these endowments, they can continuously replenish their benefits without digging into their what is it called, to their main fund. So like I said, right now, if you can find those opportunities and get a nice 7% yield, like here's an example, and I keep bringing this up, like Verizon has like a 7% yield right now based on today's value. And it's a qualified dividend. So qualified dividends up to almost $100,000 with a married couple, you pay zero taxes on it. So let's say you've worked your entire life, you saved $1 million, you put it on the side, and now you buy a whole bunch of Verizon stock, you get 70 grand a year for doing nothing. And it's a company that's not going anywhere. It's pretty safe in terms of their dividend because they've been paying it out so long. Their debt to EBITDA is, the net debt to EBITDA is actually at a very safe pace. These are the kinds of companies that I think this year are worth looking at least until we see that 15% correction. Well, let's say 15%. The reason why is because if the market is down 15%, these companies will be down maybe 5%. And the entire time they're paying you a dividend, which means that you're just stacking more capital, so.
Yeah. And I think it's about understanding, right? Like you don't need to go to the extremes, right? I think what I always try to talk about or think about is like, what do you think your expenses are going forward? So let's just say you have $50,000 in expenses. You'll have Social Security coming in. If say you're near retirement, of course, there's obviously the thought whether or not, if you're in your 20s or 30s, if it's going to be there. I'm cautiously optimistic something will be there. Will it be as strong as it is today? Maybe for some of the retirees, maybe not. But let's just say you're going to get $2,000 a month from Social Security. I don't think that people ever think about this. There's so many people that I've had conversations with to be like, let's start with the end in mind. And they think that they need like $20 million or even $15 or $5 million to be able to retire. And it's just like, no, like, let's just do some simple mathematics. Let's figure out how much you spend. And that's actually think like your house is paid off, let's say, and you're getting X amount from Social Security. Like, how much additional do you actually need? And it's actually surprising the amount of people and relief that comes over people's face when they say, oh, you mean I only need 3% sort of yields to be able to attain X? And that means I only need $1.5 million. Like, oh my God, that's such a relief comparatively to me thinking I could never retire or whatever. And so I try to help people understand, take whatever you need in terms of expenses and multiply it by 25 to 30. And if that's where you're at, you're probably okay. So if you need $100,000 a year, and subtract Social Security estimates out of that, because if you're a married couple and you need $100,000 a year, you're probably going to be making close to $40,000 a year just from Social Security. So now you're looking for 60. So what's 60 times 3? You're looking for 1.8 million. It's easier than what you really think. And if you were able to somehow figure out how to get 4%, then it's less. It's going to be way less than what you think. It's what 60 times 25, 1.5 million. So, depending on what you need and the lifestyle, etc., then, it can be much easier than I think a lot of people give credit for.
Someone's asking, did I get out of Meta? I did not get out of Meta. What I did is when Meta was at its bottom, I bought a whole bunch of calls. Meta rode up. RSI jumped when that news came out. I sold $900 calls against my long position, and Meta has actually come down. So what I did is I bought back the $900 calls and I took profit on those. So now I have a naked Meta call going up. So basically what happens, it's almost like a covered call, right? So you buy this underlying stock, it goes up in value, you sell a covered call, and then when the stock comes down, now all of a sudden that covered call becomes less valuable. So you would buy that covered call back. And so now earnings is coming up. If Meta does really well and they, say some right things, this thing goes up to 700. I can once again do the same strategy and sell the $900 call again. And so this way I'm continuously extracting value from the position. So no, I'm not like out of Meta. So it's a pretty big position for me too. So sometimes you just have to, de-risk here and there, but yeah. So let me show you guys one thing real quick. I really like this feature on what's this called? On Fiscal AI. This is the wrong one. Share this screen 1 second. Okay, so right here, share this. So if you see here, this is the dividend yield of Verizon, right? So you can see at some times when you buy it, it was yielding 4%. At some time when you buy it, it was yielding 8%. This is all based on your cost basis, right? That's the yield. But so if you look at the dividends grow over a long period of time. So if you had bought this company in the year 2000, their dividend was $1.43 per year. Now, over time, they've, gradually increased their dividend. And now the dividend is about 2.76. So had you just held it as a total return for a long time, right? Like Verizon here and around 2005, you could have just rode this up and reinvested dividends and made almost a 9x return. So while the stock price may not look appetizing because you're looking at this, you're looking at, let's look at the stock price over the last 10 years. The last 10 years, the stock price doesn't exactly look very appetizing. Look at the volatility up and down, right? And in 2009, the stock price was $29. Now it's $39. So what did you really gain? But the thing is, the entire time you're compounding your growth. And I think that's one of the things about dividend investing. And Matt has a lot of early videos where he was a dividend investor. I don't know, Matt, do you still have those out there? Do you still get hits on those?
I don't delete anything.
Yeah. So, like I said, right now, I think companies like Verizon, who are very strong in their business models, you may not necessarily see a lot of capital appreciation, but you also won't see, in my opinion, they're kind of bottomed out in terms of safety. So I think the margin of safety for Verizon is very high at this price level. There was a time last year where this thing just, I don't know, the bottom fell out, and man, I made some good money on buying some call options on this because of the low beta. Whenever you have like companies like Verizon, which are low beta, absolutely sink like this, the options are very, very cheap. And so I was able to buy a whole bunch of options, and when this went up, I was able to extract a lot of value during that time. So I tried doing that this time, and I got a little bit lucky on it. I did buy some around here. Where was it? Around here in November. So I had bought some, and then it kind of rode up, and I sold some calls against it. And I'm thinking about doing the same thing now that it's back down to 39 again. If the RSI is like goes a little bit even further down for whatever reason, I'm going to probably buy more and then and do the same thing when this thing jumps up to like, let's say 42, 43, I'll probably sell some calls against it at the time. So yeah.
Mm-hmm.
Yeah.
What was I going to state? Oh, and I think right now, going back to kind of the original thought about maybe some of these higher risk opportunities out there, I was looking at Rocket Lab because Chris, kind of made me thought, and I was dealing with some of my board of directors, like the people that I have in my life. I don't actually have like a formal company where I have a board of directors, but just people that I always, you always have to have a board of directors in your life to make sure that you're not being completely stupid. And I asked them the same question that Chris asked me. I said, am I being stupid by having, let's just say, however much in Rocket Lab and not really thinking about it? And it led me down to the path of like what Mark Cuban had done when Yahoo had bought him out, which is looking at costless collars. And I encourage people to maybe thinking about that. If you have a high risk company that you're invested in, and it really would be detrimental to you mentally as well as financially, and you don't think you can handle the volatility, and you just want to hope, because there are black swan events. You could looking at costless collars, and some companies like Rocket Lab right now, you could even do like ratioed costless collars where, let's just say you have 10,000 shares, for example. You might be able to sell 25 contracts, covered calls, and still maintain a 20-30% upside from here and get massive amounts and cover your entire position of all 10,000 shares. So 100 contracts worth of puts. So a ratio of 4-to-1, or even 3-to-1, or even 2-to-1, where maybe you only have to write covered calls on half the position. So yes, let's just say it continues to go up massively. You're uncovered on half that position, but your entire downside is completely fixed, and you don't have to come out of pocket for that. Or if you wanted to, you could do covered calls in the entire position and capture some of that premium as, income. But I recommend, I don't say go out and do this, right? I don't recommend everyone just say, oh, costless collars are the thing. Matt's advocating for costless collars. What I am saying is, if it's something that concerns you, you are in this position where you have a Rocket Lab and you're afraid it's going to drop by 50%. You have an Oklo and you're afraid it's going to jump by 50%. You have some of these other companies that you've been very fortunate in getting into, and you want to make sure you protect that downside. Just look at what Mark Cuban did with his, some people call it one of the best trades of all time, and read into it and consult with somebody that's a professional. That if you're saying, look, it might be worth you paying $100 to a financial advisor to be like, look, I have $2 million in X company, and I want to make sure I don't lose that. But I maintain some of my upside. How can I best use that? And if they have any, real sense about them, hopefully they're not going to try to convince you to do American funds and put them in their damn ETFs where they get front loads and, all that bullshit. If they're doing that, then, say I have some sense about me, and I'm not just going to hand over you my portfolio so that you can get all the AUM and charge me 2%. but I am paying you for a consultant fee to be able to understand exactly how to potentially protect myself in this sort of downside. And I encourage people to kind of look at that.
Yeah.
Mr. Patel, do you want me to share your screen?
Yeah. Can you? Yeah, this is what let me just make this bigger. So this is what a costless collar is, like, or a zero cost collar. You're buying a protective put option that gives you the investor to write the sell at a predetermined price. And then at the same time, you're selling a covered call. This obligates the investor to sell the stock at a predetermined price. So if you think that, there's a level of upside that you're willing to accept, you can use that covered call to buy an options contract on the put side, so that this way you're basically negating the cost. And so it looks something like this, right? So like I said, this is something that you learn over time, how to use these option strategies to kind of take away risks while at the same time letting your upside maintained. So like right now, as an example, this is something that I said to Matt. I said, look, you've done extremely well on Rocket Lab, and I know you believe in the company like there is no tomorrow. You think Rocket Lab should be worth 10 times what it's worth right now, but you have developed a significant portion of your portfolio because of just the sheer amount of gain that you've had in Rocket Lab. Maybe it's not a bad idea to sell a little bit of your Rocket Lab position, not a lot, a little bit, and use it to buy some long-term protective puts. So just in case there is a black swan event, you could utilize those puts to save your gains, and at the same time, utilize that put to buy more shares of Rocket Lab because you love the company and you think that it doesn't deserve to be 50% lower, right? So you don't even have to get rid of your shares. You could just sell those puts, right? You don't even have to exercise those puts. You just sell those puts. Huh? Say that again?
Buy the puts.
No. You would sell those. No. You would buy the puts so that, let's say the stock goes down. Now the value of those puts skyrockets. And then what you would do is you would just sell those puts.
Yep. Now
right? Instead of right, if you execute them, right, then you're basically saying I'm gonna sell my shares at that higher strike price, and then the value of the put goes to zero. But then you can actually sell all these things to the other person. Versus with a put, like let's say now it's appreciated significantly, you could just sell that put and use the gross proceeds to buy more Rocket Lab at a lower price, right? So now you're kind of like in a position where it's like if it goes up, you get unlimited upside. If it goes down, you're basically, sitting on insurance. Now, the one drawback to this is that let's say the company stays flat. If the stock stays flat, then you lose your money. Whatever the put you bought, you lose your money. So it's kind of like insurance in that regard, right? Where it's almost like I bought insurance on my Lexus and I haven't driven my Lexus in 6 months. That doesn't mean that the insurance company is going to come in and say, oh, here's your money back, Mr. Patel. No, they're going to say, hey, listen, whether you use the car or not, whether you got into an accident or not, it's not our business. You didn't get into an accident. Good for you. Good, God is on your side.
Mm-hmm. Yeah, Chris asked me, he's like, are you sure you're not selling any of your Rocket Lab? Like, it doesn't make sense. And what did I ask you, Chris?
Are you selling any of your ASTS?
And what did you say?
I'm going to take my own advice tomorrow, and I'm going to buy some freaking puts on ASTS. I don't care. I am going to
That's one, like, that you could potentially do some zero cost collars on that. And you could, it's the premiums, I'm sure, just like Rocket Lab. I was literally looking at, please do not go off and just be like, oh, Matt said, right? This is an example. I haven't executed it, nor am I going to execute it. But I was looking and I was like, what if I did like the February 20th, 125 calls, or maybe it was the 115 calls, and I forget what it was, but it generated like $4 in premium, to which you could, like, even if you only wrote, let's just say 4-to-1. So like if you were to write $125 or 115 call, you'd be able to purchase 4 times the amount of downside insurance. So we're talking like on, let's say, like a $50 strike on Rocket Lab or something like that. So like you are covered. And not only that, but like if you wrote a covered call on your entire position, you'd be able to capture a bunch of premium, cover your entire downside, and not, it wouldn't just be zero cost. You'd actually make up a huge credit and premium for it. And I'm sure you could do the same with ASTS and a lot of these other companies that are doing extremely well right now, because more
Yeah, the
people
only-
are willing to pay for the upside than they are for the downside right now.
The only problem that you run into is that the way that options are priced is that they're more based on volatility than the actual fundamentals of the company. So whenever you have these companies that spike really high, the IV tends to go absolutely berserk, which means the amount of money that you're going to pay for that put contract is going to be somewhat elevated, right? So you kind of have to weigh the ups and downs. Like I said, it's really about risk management and how you best tailor yourself to understand. Like, I don't know if you saw this, but dude, Palantir, I was looking at buying some puts on it just to, speculate because, me, I'm one of those guys, right? I'm a Palantir hater, right? So I was looking and
you're waiting to buy back in at 16.
I am at 50.
50. There you go.
Look at this. Look at the amount of puts that are out there.
I have $50 puts that I've sold.
You sold $50 puts?
Yeah, it's fucking free money.
Okay. How far out?
I don't remember, but it was like stupidly free money.
There are options out right now for Palantir all the way to December of 2028, right? Yep. So it's insane to see this. Let me just go right here. Sorry. So December of 2028, there are actually puts out there. Yeah, puts right here. So, but the look at the cost of these puts, man. $55 on a $175 position. That's freaking insane.
But look at the $80. Like, you could sell the $80 and get $13.
Yeah, and there's 826 contracts that are outstanding of that. 400 here. Did you? Look at this January one. There are a ton of put buyers on Palantir. Look at this. Look at the options chain on this.
I bought more spot today. I always forget that it's the 15th, so I bought a shit ton of shit today.
Yeah. Look at this. 6,000 put contracts for $20. I mean, it's barely anything. I don't know, like a pennies on the dollar, but someone's betting on it. There's 8,000 contracts for $80 strike for January of 27. Like, there are some Palantir haters, bro. There are some haters. $150 January. Look, 6,000 put contracts.
I sold December 2027 $50 puts.
Someone knows something, dude. I'm sorry, dude. Someone knows something. Whenever I see this much interest on the put side, someone knows something, Matt. They're coming after Palantir.
As much as I love the company, and I think the underlying company will continue to perform, it is a couple years ahead of valuation for sure. Even in an expensive sort of realm. But I think in the long term, the way I would justify it is I think it's going to be a $2 trillion company. So it'll go down in the short term. And if you look at the actual stock chart, I'm not a TA guy by any means. And I would be the last person to look at TA. But if you just look at the actual underlying chart of the company over the past year, it looks like you're looking off the abyss. Like, it looks like you're standing on the edge. If you bring up the chart of Palantir, Chris, because your people is shared, it looks like you're looking off the corner of the Grand Canyon. Like, it looks like if you just go to a year chart, it looks like it's topping out a pretty good bit. It's flatlining, and it was up at 207, and it's so who's to say if their earnings come in extremely well. But like, look at that. Like, it looks like you're on the corner of fucking the Grand Canyon. Whether or not it actually tips over to TBD, but I'm cautiously optimistic the company will continue to deliver, and that's what I'm buying. I'm buying because I think it's going to be a $2 trillion company someday, not because I think it's cheap at $500 or $500 billion market cap. So,
yeah, I mean, look at this thing, man. You know what's worse though? Look at this. Sorry. This one silver miner, this thing has skyrocketed. Okay, they do gold and silver mining. I was short this for like a day, and then I said, "Nah, screw this. I'm not trying to risk being in these crazy themes." But the RSI on this thing, on like even like max, look at this monster, bro. 88 RSI, historical. Look at this, $25 a share. Insane, dude. Freaking insane. Eventually, this thing is going to come down.
I have puts. I have July puts
for this one for HL
for SLV.
SLV. I figured. I knew someone was in my circle.
I saw Garcia do it, and I was like, you know what? I think Garcia is right on this. So I'm a week ahead on the trade. I think, but I have a strong optimism that it won't go above 100. But I'd be wrong before, so I'm sure I'll be wrong on this as well. But I have a strong opinion that it'll reverse before June, July. So,
dude, this thing looks like King Dakar. You ever been on King Dakar in Six Flags?
Yeah,
that's that roller coaster, bro. That shit looks like King Dakar right now. And if anyone knows anything about King Dakar, that shit when it comes down, it's even more crazier than when it goes up. It's insane. Who here in the chat has been on King Dakar? SLV to 150.
On 150, man.
That is insane, dude. Look at that.
Yeah, I'm excited that great companies like Robinhood, Coinbase, etc. They're all down in recent times, and I hope they continue to go down throughout 26, and I'll be able to scoop them up towards the end of the year.
I agree. Hood's taken a nice nosedive lately too. It got to that.
I'm not bearish on the company by any means. You know, I just think that it got a little overrun, and I also think that we're on the edge of a crypto winter, which is why I never bought BM&R. Because and I'm bullish on BM&R in the long term. I just think it's a little bit too early. So I'll be looking to potentially I have to decide which one. Maybe it's BM&R, maybe it's MicroStrategy, but towards the end of 26, early 27, man, I'm gonna make a big entry into cryptocurrency.
Have you ever used TrendSpider?
Yeah, those guys are in Houston. We've gone to a couple of their events.
They're actually really good, man. I got a free version from them, and
why don't they pay us? Just kidding.
What happened? Why don't they pay us? That's a good.
TrendSpider, Fiscal AI. I thought we were all bros, man. Pay me.
Not that broy. Let me just see. Hold on 1 second. Oh God, I hate logging in. Da-da-da-da-da. Continue. More ways to verify. Yeah, what application do you think as an investor that you've been using that's actually worth promoting? Like if they give you the option.
You asked me the right question at the right time. There's this really good 24/7 market chat that everyone should be following if they aren't yet. And let me pull it up. Have you heard about this yet, Mr. Patel?
Which one?
Let me pull it up here. It's groundbreaking. Absolutely
groundbreaking. That's what it's called, groundbreaking.
No, it's called the Street.
What is it, Twitter? The Street Exchange. I can't. Is that your channel, the YouTube channel?
Yeah, of course. It's the best goddamn thing out there. I'm gonna put it in the chat if anybody wants to follow it. You know, it will show live. Has a bunch of different information about the market indices and stocks, etc. So if anybody's curious, yeah.
Is this just your regular live? This is just your regular live stream that's on all the time?
It's not on the Matt Money channel though. It's on a completely separate channel.
Do you have any followers on there?
Like 300 or something like that. Not a lot.
You have 300 followers. Have you got like concurrent viewers on there, just listening to the music, watching the market?
Yeah, it's a trial, and I'm adding new functionality over time. But
yeah, no, I like this. This is TrendSpider, so this is like one of the charts that I have set up so that I can track when things are overbought, some volume profiles. I have the moving averages and stuff. So, and I have it set up so that I can see a lot of other companies too. So like Novo Nordisk, and it's nice color coded too. So this way, if there's any divergences or anything, I can keep a track of them and get into them, So yeah, like the one that I like is Meta. You can see here when things got oversold right here, it was a good opportunity to buy. And then when they started to go up, it was, it was a nice upward move and it was a good time to sell. So these arrows, these candles help you kind of like see when things are getting oversold and overbought. So yeah. So stuff like that. You can actually put other indicators on there as well. They've got a lot of great things. I really need to learn how to utilize this because they've got so many technical things that like Ichimoku clouds, and so you can kind of see though some of this stuff is very like technical. And I know I've always kind of made fun of Jason, like I'm like, oh, technicals is just voodoo, but technicals is not voodoo. It is voodoo. Screw it. What am I saying?
It's voodoo to me.
It is voodoo.
It's right until it's wrong, in my opinion. That's the way I look at technicals, right? Like it's never 100% right, but nothing ever is. But it allows you to at least give you some confidence in trading in the short term or longer term, depending on what you're looking at.
Well, I like what Josh Brown says about the markets. Like fundamentals tell you what to buy and technicals tell you when to buy, right? So when you see something that's technically oversold, but the fundamentals look good, that's an obvious like, hey, that's something worth buying. If on the other side you see like fundamentals are deteriorating on a company, you can't get me to buy it no matter what until those fundamentals, fix themselves. Like it's like saying, oh, look, this typewriter company is technically oversold. Bro, who the hell is trying to sell typewriters? You could give me the typewriter company for $1 and I would say, no, thank you. Because there's not going to be worth anything because the fundamentals are broken. Right.
Yeah.
So, that's the way that you would go. Man, Rocket Lab and ASTS are holding us together, man. All right, go ahead.
No, that's it. I mean, yeah, just figured a lot of people have been wondering. Obviously, we haven't shown this in a while because we haven't been streaming, but obviously we still have the portfolio. I have to check. I might have missed the January payment. I have to see if we made over $100, but we haven't been streaming as well, so we might not have had any more capital to add. But we did get a VG dividend recently. VG still being our largest position, but we're down. Obviously, the cost basis is $9. But that reminds me also, I need to be keeping up with these covered calls, man. What am I doing?
I know. What are you doing, bro? What are you doing?
I'm slacking. What am I doing? But yeah, it'll be nice. I think we've seen a good rebound in this one. Next decade, which I think is a little bit further down the list, not doing as hot, but we haven't been adding as much money either. So that maybe if we get a little bit more capital, that's one that we potentially add money to. But we still have some other ones. We're down on Webull a good bit. But everyone else is doing rather well in the portfolio, or at least maintaining overall. Where do you think we ended up in the last year compared to the market? And where do you think we are year to date? I'll tell you, one's way better than the other.
I mean, bro, Rocket Lab and ASTS are holding the portfolio together. So I'd say we're at least performing the market. If they were much bigger positions for us, then maybe we would be outperforming. But I think on average, we're probably 2x the market. We're twice
in the last year or year to date?
Year to date.
Year to date. I think you will be surprised, Mr. Patel. You ready?
Really? Yes. Well, technically, no. VG really killed it the last 30 days. They were up 30% in the last 30 days. So I'd love to see it. Yeah.
So on the left, we have year to date. So year to date for the SPY is only 1.2%. Keep in mind, this doesn't include today, but it includes yesterday. Yeah. So it's as of yesterday's end of market, we're up 12% year to date, which obviously, like you stated, Rocket Lab, Venture Global, ASTS, I think is the large holders of that. And next decade has come up a good bit as well, even though we're still down a large bit on that. That's that. But at one point, I think I think when Venture Global and Next Decade took their tumble in November, December, we were actually underperforming the market in the last year. So the one on the right is the last year. We're only up 31% compared to 20. But I think a lot of that has to do with the poor performance that we have, and probably, I don't know, what is our overall portfolio in LNG? It's 19% for VG and 9%. So like over a quarter, almost 30% of the portfolio is in LNG stocks. So
Yep. Bitcoin were up 28%. At one point we were higher. Let's see. Meta's been flat, which is kind of surprising, considering just how strong of a business that. Yeah, I mean,
fine with me, man. I in the short term, I would love for it to stay here because it's super cheap, and as long as they're able to continue to perform, then
broski, your performance on the stock draft. That's stuff of legends, bro. That's amazing to see that. You are.
I don't even know where I'm at.
You're destroying everyone right now, like by like a long shot. Primarily because you've got ASTS and well,
this isn't the right one because Steve.
No, I have the other one. Let me pull it up.
Yeah, if you have the right one, I'd appreciate that.
I'm actually working on something for us for the next stock draft.
I've heard rumors. I've heard rumors, but I you haven't told me personally, so I'm excited to hear. When you release
we'll release it and then we'll present.
And when while you're pulling that up, somebody's asking why no Cheniere. Cheniere's great, but just if you're looking at adding today, I don't want to say Cheniere's done because they're not. They're adding still adding expansion projects at Corpus Christi. They're adding expansion projects to Bean Pass. But in terms of where the companies are today, in terms of their value compared to where they will be, Cheniere might be better if you're looking for stability and, security on your money. But if you're looking for capital appreciation, I think VG and Next are going to be better opportunities.
Okay. So we'll start off at number 5, the oldest among us. Steven is down to 3%. He's mostly got screwed over by MSTR and HIMS, and even some degree Netflix. But his win on Micron is saving him from going into the negative. So that's crazy that Micron ran up so much.
Not what I expected out of his portfolio for Micron to be the one that
Micron saved him. So, and then comes second to last loser, which is me. I have UNH, which is, they're doing okay. Google is absolutely killing it for me. But then I've got Axon, which has been recovering a little bit lately, which is doing okay. ELF is definitely not doing well, but it's not like killing me. So that's ELF. Then Oracle, because of all the debt issues. At one point, Oracle was actually up almost 20-30% in September when they first announced their partnership, I think, with OpenAI and stuff. But then since then, because of just how much capital they're committing, they're down. And then Novo Nordisk has been coming back, mainly because of its Ozempic pill, like a Wegovy pill. So that's starting to come back up a little bit, but it's still down. And then Take-Two, which is the maker of Grand Theft Auto, that's just been flat. So that's me. So that's second to last loser. At least I'm positive by a good margin.
Is Elf on the Shelf going to make a comeback? I've heard some people that are like, it's overdone. I don't know. I don't follow the company, so I'm just curious if you do.
If China tariffs get overruled, then Elf on the Shelf will definitely come back. But until then, I think they're going to be in limbo land for a while. But anything can happen. Victoria's Secret recovered, so it'll happen. And then Tanner. I think Tanner is number 3. Yes, Tanner is number 3.
It's a healthy return.
So Tanner, Nvidia is his 30% position. Nubank is giving him 34%. He hasn't done too well in Mercado Libre or ServiceNow, and TTD has really whacked him. But he's got some really good winners in AppLovin and ASML and TSM. So these are really holding him up nicely. So he's got 1, 2, 3, three positions that are really not even three. These two are probably dragging him more than anything. And he's got Coinbase because of crypto winter. That's probably killing him a little bit too. But TSM
What is ASML? Is that a materials?
ASML makes the lithography machines for that are like super precise for NVIDIA GPUs and everything. So ASML makes those lithography machines. TSMC buys them for its fabs, and then NVIDIA designs their chips, and then TSMC manufactures them using the tools provided by ASML. And so ASML is like the linchpin of pretty much of the chip economy, basically. So they're the only ones with like the sophisticated enough machines to be able to produce circuits that small. Like so yeah, and they're amazing, man. So he's doing really well on that. The only problem with his portfolio that I see is that if the AI story takes a tumble for whatever reason, he has a lot of concentration in that. So NVIDIA is an AI play, ASML is an AI play, and TSM is an AI play. So this AI play is gonna hurt, you know.
Mm-hmm.
So yeah. So this is crypto software, advertising software. TTD is software, advertising software. This is like a selling platform, neobank, software, crypto, and TSM is like chips manufacturer, contract chip manufacturer. And then Amit. Palantir is doing okay for him. Robinhood was doing really well for him at one point, but that's kind of pulled back a little bit. Nebius is really helping him out. That's almost 100% higher. Apple is also helping him. Grab has been kind of Grab and Visa, which I did not think I would see them negative, to be honest with you, are lower. And then Duolingo has absolutely like brought him back down to earth. So right now for number 3 position, Tanner and Amit are closer than what they were just a month ago. Like a month ago, he was clearly like killing it, but you know, that's just how the cookie crumbles sometimes. Mm-hmm. And then of course there's Matty Mula with his 241% gain on Rocket Lab. And then ASTS 141%, and then SoFi 77%. So even if everything else is underperforming, those 3 are just killing it for you. And Abceler is also doing well because he just got such a low cost base. So yeah, Bros is not holding up and EOG is not holding up. And then Berkshire is also kind of flat for the year.
Bros just did one of their first acquisitions, actually. I don't know if you saw that.
I did not. I haven't been tracking
It's a small, so actually it's a pretty interesting story. So it's like a 20-unit coffee company, just very similar to what Dutch Bros is in terms of like how they operate. But the guy used to be a Dutch Bros employee and in the West Coast, and he ended up wanting to be a franchisee. And so he went through the process of becoming a franchisee for Dutch Bros. And then that's when they decided, hey, we're actually going to go public and stop franchisees. And so he was like, well, shit, like I still want to do this. So he moved to North Carolina, and I forget when this was, but it was a couple years back, and he started his own competitor. And, you know, around the same sort of thing, make people feel good, you know, make your employees feel valued and really give them a quality. It's about how you're delivering the coffee and making it an experience rather than just the coffee itself. And they said, hey, you know, what are you doing? You want to get bought out? So I think it's a bolt-on for them because it's a very comparable culture, obviously, because it was based off of Dutch Bros originally. And it helps them gain 20 stores in the North Carolina, South Carolina area. So they're coming for people on the East Coast. And it just goes to show you, I hear a lot of people talk about 7 Brew and a lot of these other small pop-up that are like growing like wildfire. And so it makes me cautiously optimistic that if those other small companies like 7 Brew and some of these other companies that recently have popped up on the Eastern Seaboard are performing well, that there's a market for consolidation, and Dutch Bros, I think, is the upper hand. I mean, you're talking about a company now that's worth $8 billion and has like less than $300 million in debt, they can easily go and acquire some of these smaller coffee co's and take over the Eastern Seaboard. So like Seven Brew was one that I tested out actually in New Jersey when I was working on the house. And it wasn't bad, but I just think the Dutch Brothers is better.
I got to tell my wife there's a Dutch Bros in Tucker now. It's not too far away from me. Before
they're
it was
growing
all
like
the way up
wildfire, man.
Yeah, up before they were up in Johns Creek. I gotta tell the wife. Maybe we'll go tomorrow.
They have a new menu.
Yeah?
When we went, they only really had like the 3 muffin tops, and it might show on here, maybe it doesn't. But yeah, if you go to snacks, maybe it has a new menu, maybe it doesn't. But they have like chorizo, like wraps. They have like a chorizo wrap. They have a banana loaf. I actually had the banana loaf for lunch today. So this isn't the latest menu.
Okay.
But if you look up online, it'll show the latest menu. They actually have a bacon slider, sausage slider, a few other.
Dude, how are they able to make that in such small conditions? Because that's the thing about them, man. Their stores, like if you see a Dutch Bros location, the footprint is like nothing. Like this is what it looks like. They're like literally carts. See that?
Yeah.
Right there? Sorry.
Yeah. Small footprints. I would love to buy the real estate actually.
Are you looking to do some triple net leases? Because I've been actually looking to diversify into that.
I have looked at it, yeah.
Because I mean, that is a nice income stream that right now I have to talk to my accountant because you can depreciate things in the first year. I think I have to find out because he was telling me about it, man. If anyone in the chat, if you got some triple net opportunities in, let's say, Chick-fil-A, Burger King, Dutch Bros, y'all let me know. All right.
Yeah. That's the thing. It's tough. Yeah. It's tough because like if you do build to suit, you might be able to make some decent money on it. But then you have to find the person that wants to build it. So it's like if you find a Dutch Bros, like you can get pretty good cap rates on a Dutch Brothers, but you have to get Dutch Bros, right? And they're only doing 150 stores a year. So it's like, you know, will you be fortunate that you get Dutch Bros to show up, or are you going to get some no-name, you know, other coffee company that wants to rent it out, and you're like, I don't even know if you're going to be around next year. Like, so it's interesting. And right now interest rates aren't favorable enough where it's like super convenient to get like a Chick-fil-A. Like Chick-fil-A is you're going to pay a 4.5-5% cap rate. And so obviously when you're paying 6 or 7% in interest rate, you just can't make it work unless you're putting down a shit ton in money. So I don't want to put down like 50%. So
someone in the comment section, they were saying, oh, Chick-fil-A doesn't offer franchise. We're not talking about franchising. We're actually talking about doing something called a triple net lease. So basically what you would be doing is you would buy the business itself, like the property, and then Chick-fil-A would pay you rent. But the benefit to this is that it looks really low. Like right now, if you look at, let's say this right here in Emporia, Virginia, right? It would cost you $7 million and then the cap rate is 4.75%. And so the annual rent that you would get is $322,000 a year, right? So you would be buying this Chick-fil-A, you would get this, and the cap rate looks like absolute trash. But and here's the kicker, these rents, they usually have something called escalators built into them. So what happens is every few years, the rent goes up by a smidge. And then
just like an apartment.
Just like an apartment, yeah. And then it goes up by a smidge after that. And then it'll go up a year after that. And so what happens is over time, you know, if you had bought something 15 years ago at, let's say, a 5 cap rate, by now, because of all the rent escalations, that cap rate is probably like 10, 12%, right?
On your money, so on your investment.
Right, on your investment. And the beauty of these things is that you're basically not doing anything. Like they pay for everything. Like they do the building's maintenance, I think they do the taxes, they do utilities. So you're basically just collecting money from Chick-fil-A, you know.
Yep.
Now
that's what a lot of like Advanced Auto Parts, AutoZone, Wendy's, Burger King. The reason why they do this, guys, is because if you look at it, the cap rate is only 4%, 5%, 6%, 7%. Depending on Chick-fil-A is obviously really low. The reason why they do this is because, like, yeah, they could own the real estate, but that also means they have a shit ton of capital where they could be, you know, doing other things with it. So if they're making a return on capital of 20%, why have it in the real estate? Because in the real estate, you might only be making 4 or 5, 10%. So that's the reason why they'd rather have somebody that's looking to own the building and buy the buildings, etc. Because then at that point, they can use their capital. They know they have a building, they know that they can reinvest and build more stores, etc. And you're sitting there happy because you own a building that's, you know, making whatever and increasing rent over time. So Dollar General, it's another one that
Dollar General, you know, like McDonald's, like, you know, Burger King. The only part that sucks with these things is that, let's say you did a deal with this Taco Bell, right? You got a 7 cap rate. You're like, oh my God, this is great. I'm getting 7% a year. I invested $3.2 million. My annual expected rent is going to be almost $200,000. I'm getting monthly $16,000. I'm happy camper. And then they decide, hey, listen, we're not going to continue on our lease. And they basically pay you out. And then you have to try to find another tenant. You know, that's bad because then you have a building that doesn't have this anchor tenant. Usually you have to be, and that's one of the reasons why, if you have someone who's a good creditor, you can get, you know, the cap rate looks sort of low. But then if they're like kind of shitty, you know, shitty creditors, like they are prone to kind of closing up the business and leaving and stuff, then you kind of have to like adjust that risk and you know, be like, no, I want a higher cap rate because I'm taking a higher lease. I mean, I'm taking a higher risk that you'll just close up shop and move. And that's what happens. Sometimes businesses, they consolidate. You know, they don't see enough foot traffic. Like this Dollar General right now, you could buy it for $1 million, like 1.3 million in where is this? In Iowa. And the annual rent you're getting is $100,000 or like $95,000. So you're happy. Problem is, let's say this Dollar General is not doing so well. So Dollar General corporate says, screw it, we're going to close this. Or let's say it's coming up on its lease expiration and they decide they don't want to renew it.
Yeah. And that's why Chick-fil-A is a 4.5% cap, because somebody said they never see them close and move. But another thing that people need to look at, if you're actually interested in this, one thing that you need, exactly what Chris is talking about, there's things called franchise-backed and corporate-backed, right? So if you have corporate-backed triple net lease, like let's say Walgreens, a lot of Walgreens are closing right now. So that's why people are charging like 7.5%, 8%. But some of these Walgreens that are maybe at 7%, they might be corporate-backed. So if they say we're not renewing the lease or we're leaving early or we're shutting down the store, corporate has to pay out still regardless. But if it's franchise owned, then you're fucked because, you know, that franchisee is like, well, I'm not paying you, so you're screwed. So it really just depends on the credit rating of whomever it is. Obviously, the credit rating of the businesses is likely to be better than the credit rating of the actual franchisee. The person that owns the franchise.
So someone has asked a really good question. Let me just share real quick and share this. The reason why they call it a triple net is because when you do a single net, you basically cover the base. They pay the base rent and they pay property taxes. You have to pay insurance and you have to maintain the common area. If you have double, that means that, you know, they'll pay you a rent and they'll pay the property taxes, and they'll also pay the insurance, but you have to take care of the common area. If you get a triple net, which is the best one, they pay you rent, they pay the property taxes, they pay the insurance, and they take care of the facility. And so you're basically getting paid to do nothing. And that is generational wealth. Like I know someone, like, okay, my I have a family member This dude owns, I think, like 13 or 14 Jack in the Boxes.
Mhm.
Insane. He owns them. So
The buildings
he just
or the
buildings,
franchises. Yeah.
no, the buildings and the franchises.
Okay, there you go.
He's killing it, you know. So in the future, what he's going to do is sell the franchises, but keep the property, and so he keeps it as a triple net. So basically, he's just collecting rent, you know.
Mhm.
So yeah,
If you can keep them employed, man, or like keep them filled, I mean, it's the
Now-
easiest money that you can make.
now there is a way to invest in triple net properties in the stock market.
Yes.
Now, this is where there's companies like this. There was like one that Berkshire Hathaway invested in. It was called Store Capital, right? They got bought out. I wonder if they're still like, hold on, stock. Is it still out there? No, I think they bought them out completely. STOR.
I think so. Yeah.
Yeah, Berkshire Hathaway, I think, bought them out. But Store Capital was actually one of the better companies to invest in at the time. Let me just show you guys. So basically what they would do is they would go out there and they would buy the stores, and then as a shareholder you would get paid a you know, like a dividend from that. So you can see here in 2022 they paid $1.80 to 18. In 2021 it was $1.50. So this one, instead of like, let's say I only have $100,000, well, I could just buy stock in Store Capital and I'm getting paid. If you want to learn about this, Steven is your guy. Steven knows more about this stuff than most people. I mean, Matt's pretty good too. I'm not the biggest fan of triple net like companies that own triple nets. Like another one is like SPG.
Well, Realty Income is like the
Realty Income. Yeah. Realty Income. Yeah. Like Realty Income. So right now they have like a 5% dividend. Damn, Realty Income's up this year. What's going on?
interest rates, man.
Oh yeah. And remember, they have escalators. So you could have bought Realty Income for like $10 in the year 2000. And since then it's up 600%, right? And the entire time you've been collecting dividends, and it's like an 81 cents quarterly dividend. So let's say you bought in the year 2000, that 81-cent dividend per quarter, right? So it's like, what? That's 240. So that's a 24% dividend that you're getting paid every single year.
What are you talking
But
about?
you had,
What do you mean 24%?
if your cost basis is $10,
Oh, okay, got it.
right, and you're getting paid 81 cents quarterly, that means that you're getting like, you know,
32%, Chris, but it's okay.
It's 32. You're right. Sorry, 32% return every single year. But your cost basis has to be that low amount,
$10, yeah.
right? And so this
Realty
is what
Income, believe it or not,
Yeah.
pays monthly. It doesn't pay quarterly.
No, it says quarterly. It pays monthly.
Pays monthly, my guy. Reality
Wow.
Income. Just kidding.
There's no way. I thought it was quarterly.
That's why it's called the Realty Income, the monthly dividend company.
Are you sure? Oh shit, you is correct, sir. I am wrong. You are right. 27 cents. Yeah.
And
Oh,
for
man.
anybody that does a traditional sort of analysis of like, but the PE is super high on, just so everyone's aware, on real estate investment trusts, you can't use PE. Just like how everyone talks about how you have so much, and this is why I say like you can't always trust price to earnings ratio. I like to look at cash flow, and this is a prime example. So in real estate, you're allowed to depreciate a lot of the value of the property, and it artificially pushes down your net income, so that reduces the amount of taxable income you have. So that doesn't actually impact the cash flow. It just impacts how much taxes. So keep in mind, when you're investing in something like a Realty Income, you're looking for a price to funds from operation or adjusted funds from operation, like Chris is pulling up now. And that is what you're looking at. So if you're looking at like Stag Industrial, which is a warehouse REIT or what have you, you want to look at FFO, funds from operation.
So right here, you see this? FFO. So, yeah.
Because look, net income super low, but that's because they have so much depreciation.
Yeah. Adjusted FFO is here, 105. It's flat for the year, man. Yeah, you got to talk to Steven about this shit, man. I'm all right. The challenge with something like Realty Income is that they also have debt on the balance sheet. And so if they have to refinance at a higher debt level, that means that now that's less money that's in there for shareholders, right? So let me just bring it up. This is where I love doing. I don't think anyone does debt analysis like I do. I'm just better at debt.
No, you do a great job. You do a good job of it. The thing that's you have to recognize with REITs, though, is you have to be comfortable with dilution, because that is actually how a lot of them grow, right? So what a REIT and an MLP mostly do, I'm sure there's more distinct changes, but MLPs, master limited partnerships, and REITs, they both give the majority of their distributable income back to the shareholders. So you're taxed more so at the shareholder level. So not good if you do not own in a tax advantaged account. So a real estate investment trust, if you're buying it and you think it's like, oh, it's a 10% yield, and you're in a 40-50% tax bracket, especially if you're in, say, California, you're at a 50% tax bracket, the effective yield of that's only going to be 5%. Versus if you're to invest in, say, Verizon, if you remember Chris talking, and you're in a 50% tax bracket, then, and let's say Verizon was also yielding that same 10%, you're going to be able to walk away with like 85 to 80% of that dividend. So an 8.5% yield, because of the fact that it is a normal dividend rate versus Realty Income is going to be taxed like income.
Yeah. So if you guys see here, look at the debt levels. The
You're,
debt levels.
we're sharing the wrong.
Sorry about that. Share screen, Realty Income. There we go. So right here, you can see like Realty Income has taken on a lot of debt in order to finance its acquisitions, right? So over time, they want to keep acquiring more and more properties so that this way they can keep generating more cash flow and pay out that dividend. But sometimes what happens is if you take on too much debt, like they're doing right now, when you're doing your refinancing, you're basically adding on more debt. So we just take this away. So you can see here where they were paying it prior to the surge in interest rates, they're paying about $300 million a year in interest charges, because this is on a TTM basis. Now they're paying almost $1 billion, right? So if we just look at their cash flows, right? So if you look at property revenues, you can see here that their revenues have been climbing higher and higher, but at the same time, they've been paying more debt, right? In which case that sort of impacts your operating right here, your net income. Yeah, net income attributed to shareholders, consolidated net income. Yeah. So you see that net income is just pretty much flat. The reason why the net income is flat is because you're paying more and more in interest. So this is the challenge that you run into when interest rates go up. Now, let's say the interest rates start to go in the other direction, right? That means that they might end up starting to save some money on their interest, in which case that means that there's more money left over to pay dividend, like shareholders. Right now, they seem to be accumulating a lot more debt. I mean, this is actually revenue. Sorry, let me look at the total debt picture. Long-term debt. Just hide it. That's why. And let me just hide their revenues. Okay, there you go. So you can see here that they have a ton of debt. They have almost $26 billion in debt. And all of these things, like you have to look through the company to identify what kind of maturities that they have. So this is the one thing that a lot of equity people, they don't do the research on, and it could bite you in the butt if you don't do a proper debt analysis. And this is like one of the things that I'm trying to eventually create, which is like a debt analyzer tool for everyone, like for retail investors who can plug this in and see if there's any major maturity walls that are coming up. So So usually when it comes to debt, you can kind of see that. Look at all of this debt right here, right? They were able to issue debt at 1% at one point. Well, that money is coming due. And then this one, which is 1%, is also coming due in 2027. Now, what does this mean? That means that any debt that's outstanding for here, if they have to refinance it at today's rates, it's probably going to be close to 6 or 7. So if you think about it, they were paying 1% interest. Now, all of a sudden, they're paying 6%. That is a 500% jump in the amount of interest that they have to pay. So let me just take a look how much of that is still outstanding. Balance sheets, cash flows, debt, liabilities. Let me get that liabilities page, brother. Total liabilities.
Maybe type in notes, maybe.
No, they usually have like a section where they say where these things are. Like it's usually like a footnote. So let me see. Hold on. Table of contents. Net increases in revenue. No, I want to see your debt, son. I want to see your debt. Secured notes. Okay, so this is one of them right here. So this is investments in loans and financing. So they have, this is what they own as a, I think this is loan. The following table presents information about our loans as of this. Investments in loans. So this is them investing in other loans. Credit facilities. Number of properties. This is like mortgages payable. So this is one of them. This is it right here. This is maturity. So years of maturity. This is it right here. There we go. So this is what you use to figure out what kind of interest that they're going to end up with if interest rates go in a certain way. So one of the tools that I have with Excel is that I would take all of this debt, use it to figure out, okay, let's itemize like how much money they owe. And then if the interest rates of this, like the prevailing interest rates stay at a certain level, what is the additional interest that's going to cost them the years going forward. So let's say we have a higher for longer scenario. Realty income is actually going to have a big problem because you see all of this debt that they have coming due. If you have to refinance all of this debt at higher prices, it kind of impacts your cash flows, and it's going to impact it pretty badly. So, and look at this; they have so much debt outstanding. But once again, you have to run a debt analysis on this, and then some of this stuff they have like currency risk as well. So they have some debt that's denominated in pounds, sterling. Some of them is in euros. So you have to also translate between currencies as well. So, see, this is the thing, man. They have a lot of cheap debt, but if this will be a victim of this company will be a victim of higher for longer, bro.
It could be.
This is not fun. Yeah.
But they just
I
did.
don't know how,
it looks like they've
yeah.
got some recent ones that they did that they're getting at 5%. But like you stated, if it's going from, some of them are less than 1%. So it's like if you're going from less than 1% to 5%, it's a lot, especially on half a billion dollars.
Yeah. So this is their refinancing schedule. So 2025, they have about 550 million that they have to refinance because this is from September. 2026, they're going to have to refi 2.3. 2027, they'll have to do 2.3. So it's not terrible. They don't have something called a maturity wall. So imagine right now in 2026, they had $10 billion to refinance. That would crush them because now how do you refinance $10 billion if you got it for, let's say, 1 to 2%? If you've got to refinance it at 6 or 7, there goes all of your cash flow at that point, in which case now they have to cut the dividend. And if they cut the dividend, now all of a sudden, all of these dividend investors, they lose confidence, they go sell, and O goes from whatever the price it is to like much less. So a lot of times you need to pay attention more for companies like this to CFOs rather than CEOs. CEOs can shine a lot of light into the future ideas, but the CFO is the one that controls the purse string. So
That's a good statement underneath that table that you just read. As of September 30th, the weighted average on our notes was 3.9%. So as you stated, like the averages that I'm probably going to think that are going to be coming out is 5% right now. So if you were to just play this out for 6 years for the average maturity, I'm sure it'll climb up over the short term.
Well, that's only if we have a higher for longer scenario, right? What if we get a whole bunch of cuts and things start to go in the other direction? You know?
Could be.
But yeah, this is one of the challenges, and probably that's why O is underperforming relative to its historical. So let's see O. Yeah, see. At one point,
that's when I
like
sold somewhere around there.
70? Nice.
I don't remember when I sold, but it was before interest rates started going up.
Yeah, and since then they've kind of been flat. So imagine you had bought it at $70, you would have just been pretty much collecting dividends the entire time.
At one point before I started buying, and I think might be part of the reason I sold. At one point, before I started buying actual physical real estate, I was using this as a proxy because I was like, at the time, I was getting close to 20 or 22 cents a month in dividend income. As long as I remember, and I was up to 1,000 shares. So I was like, oh, well, if I'm using this as my proxy for real estate, I'm using it as my rent basically, and I'm cash flowing $200 a month. But the thought that I kind of was skewed is like, yes, you might be getting the monthly cash flow, but are you getting the principal pay down that real estate provides? And the answer is obviously no.
Yeah. Here's another one, VC. A lot of people love. How do you say this one? VC? VC? Yeah, they own casinos, so they own the property under the casinos in Vegas. They haven't really moved much, but the dividend's almost 6.3. I'm not a fan of this. I don't like real estate like that. I think Steven likes this more than I do. Okay, I think that's it. We can end it here, man. I don't know if there's much more we want to cover. I think we went on a wild tangent.
As always.
Yes, sir. Yes,
but appreciate everybody. Ms. Patel, do you have any last thoughts for the world now that you're coming back to consciousness about ending the show?
Fixed income. That's where we want to be. Let's go. We're gonna find some good opportunities in fixed income. You know, hopefully.
Chris is an old man.
I am an old man. If you're an old person, look me up. We'll do well on fixed income. You don't have to take these crazy risks with Banana Llama, Ring Dong, whatever company that's out there trying to build weird stuff. Yeah. Multifamilies are good and triple net. Maybe.
Well, yeah, my thought process is look up if you're interested and you're sitting on something that you're, it's losing you a little sleep based off of the volatility, what have you. Look up costless collars and investigate it. Don't just blindly do it because you have to recognize what you're getting yourself into. I have a lot of people that say, Matt, teach me how to do this, teach me how to do that. And then they're bugging, no offense. And then this isn't many of you, but it's some of you. They're like, Matt, no, like you need to teach me. And I'm like, fine, you want me to teach you? Here. And then next thing you know, they're like bugging me like, oh my God, I sold a covered call. And I'm like, well, did you sell it super close to the money? Yeah, but I didn't think. And I'm like, well, did I tell you to sell close to the money? No, you told me to sell far out as possible. And I went 6 months down the road and I didn't listen to you and you got to help me. And I'm like, it sucks to suck, my guy. Like, don't get greedy, So, and then next thing you know, you're messaging me 24/7 and I have a life too. So, but yes, just, make sure before you enter some of these contracts, you do your due diligence. And I make fun of that because I want people to be sure that they're actually understanding and comprehending and not just blindly chasing people, because I have a strong suspicion that when the market pull does happen in the next 6 months to a year, where some of these easy money companies, like we've already started to see, don't recover, right? They're down 40, 50, 60% because they say AI in their earnings report, but they don't actually do anything with AI. And people are starting to recognize that. And so people start to sell them off. that you're not just being like, Matt, you need to help me. I'm down 50% because I followed Billy Bob Thornton into some AI stock that he has no idea what he's investing in, but he was trying to make money off of YouTube. It's like, I actually want people to make money. I don't necessarily need this income. It's nice to be able to generate it, talk to people, but yeah, I think a lot of people will just blindly trust anybody without fully comprehending. So as always, keep in mind the 5 key things that we talked about: objective, time horizon, risk tolerance, etc. Just because Chris is doing something like telling me to sell all my positions and put it into fixed income, like he did the other night on New Year's Eve.
I told him, I said, sell all your shit, put it into some fixed income, and go out into the sun and retire, man. Enjoy the rest of your damn life. Matt is at that level where he can retire, but he chooses to share his knowledge with you guys. Eventually, Matt is going to say, F all y'all, you know?
I believe it or not, this is where I'm at. I get so many messages, and I love some of the messages, but some of the messages are like, I'm just like, my God, like, just use Google, please. Like, do something. But some of you guys have really intricate things that I love, and I love hearing you guys share the wealth stories, right? Like because of you and Chris, I learned how to do XYZ, and I ended up buying this because of what, you kind of, you led me to water. I drank the water, and now, I was able to buy my wife a dream car. Like I've had a lot of good success stories about that. But yeah, it's pretty interesting how, like, I don't, as much as I'm sure your dog Milo is great, I don't need to see pictures of them in my DMs, stuff like that. But yes, if I can help you in any sort of way, shape, or form, and you actually do have a serious, issue, please message me. But yes, it is pretty funny.
Book your flight? Do you book your flight to New York?
No, I need to.
See, I couldn't wait for you anymore. I booked my flight. I'm flying in Thursday night. I'm staying at Amit's.
I'm glad you said Thursday night, because I was thinking about flying in Thursday night. Because I was like, I'll work from home on Friday in the hotel, and I was like, I don't want to get there Friday night because I'd like to go out and hang out with people, and I'd like to get dinner with you Friday night if you're free.
Yeah, I'm down. So come on Thursday, bro.
One's in the chat, please. One's in the chat if you're going to be in New York. Would love to meet you guys.
I'll tell you when I'm landing, so this way we can meet up. Because I'm just gonna Uber it to his place after. So I'll talk to you offline about that. So
yeah, you don't need people trying to get you at JFK.
Find me at the airport.
Yeah, they'd be like, I'm gonna catch this motherfucker before he gets in his cab.
Newark.
You don't know that? Could be JFK. Could be LaGuardia.
Could be. All right, guys. See ya.
You sent pictures. You talked to that.
You guys in Friday. We're staying at the hotel, by the way. We're not staying at Amit's. All right.
I can't afford it.
I'm just staying at Amit's that one night. That's it. The other nights,
Amit said he's going to charge me. He said, Matt, you got money now. I need to charge you if you're going to stay here. He didn't actually.
I'm an adult. I'm an adult. I like sleeping in my own bed.
Oh man, I need to. As much as I love sleepovers, I can only do it for one night. Only one night.
Dougie, me and Matt owe you a lot of drinks, Dougie. You're like one of the few people who always like throws up some dough at this Cashflow Chronicles. We should just call this like Cashflow Chronicles and Dougie Dallas.
And sponsored by Dougie Dallas.
Dougie's the only one who throws money at us. We don't have like the triple V's watching our show, But you know who does? Derek does watch our show. He got into VG with some serious weight.
And he bought below 6, so he's up to $2, a whole $2 a share. So he's up. I don't know if he's publicly disclosed how much he has.
We're not going to discuss.
He's got a good amount. But all right, you guys rock. Thank you, and hopefully we'll see you guys Tuesday. Hopefully, fingers crossed.
Knockdown Dragon Bloodsport game at Monopoly at Amit's. Okay, I was thinking more like beer pong or something, but okay, that's what you want.
There's Blood Pirates to the Death or Monopoly or whatever the hell you guys are talking about.
Good night, guys. Have a good one.
Cheers.
That's my quant.
Your what?
My quantitative.
You show me a pay stub for $72,000 on it, I quit my job right now and I work for you.
Be first, be smarter, or cheat.
I'm not fucking leaving.
Sell it all today.
Or look at it say, it's beautiful.
Welcome to the fucking show.